Guaranteed renewable life insurance under demand uncertainty. Guaranteed renewability or GR is a prominent feature in many health and life insurance markets. We develop a model that includes unpredictable and unobservable fluctuation in demands for life insurance as well as changes in risk type observable over individuals' lifetimes. The presence of demand type heterogeneity leads to the possibility that optimal GR contracts may have a renewal price that is either above or below the actuarially fair price of the lowest risk type in the population. Individuals whose type turns out to be high risk but low demand renew more of their GR insurance than is efficient due to the attractive renewal price. This results in imperfect insurance against reclassification risk. Although a first-pass efficient contract isn't possible in the presence of demand type heterogeneity, the presence of GR contract nonetheless improves welfare relative to an environment with only spot markets. Guaranteed renewability or GR, which is a prominent feature in health and life insurance market, provides an opportunity for individuals to insure against reclassification risk. This works as follows. Consider a set of ex-ante identical individuals, each of whom purchases an initial 10-year term life insurance contract with a view of possibly purchasing a subsequent policy at the end of the term. By the end of the contract period, some insured may have discovered that their mortality status has changed. If this change is observable to insurers, then the price for a new insurance contract will reflect that change in risk. Individuals recognize ex ante that their risk type may change over time and so prefer to avoid the prospect of premium risk associated with stochastic mortality prospect. GR contracts contain a promise to offer a subsequent insurance policy at the expiry date of the first contract at a price that is independent of any changes in a mortality risk. The premium for the implicit insurance against reclassification risk is embedded in the first contract earlier period through an extra premium assessment, a phenomenon known as front loading. This allows insurers to offer insurance to those individuals who turn out to be higher risk types in the subsequent 10-year period at a price below their actuarially fair rate. As long as the amount of front loading is sufficient, the added profit from the first period contract compensates for insurers' losses from the second period contract. In our paper, we focus on the implication for GR and long-term insurance to ameliorate premium risk when individuals face uncertainty over future changes in both mortality risk and insurance needs. We consider an environment where individuals face no capital market imperfection, they can borrow or save at the risk-free rate, nor other impediments such as the existence of resettlement of theoretical market opportunities that can thwart GR insurance to fully protect against reclassification risk. We developed a two-period model of insurance in which individuals are homogeneous in the first period and hold the same belief about the likelihood of becoming a low or high demand type in the second period. An important feature of insurance demand is how it changes over the life cycle. As noted in Hong and Raya's Rule 2012, average demand follows a life cycle pattern that rises from young adulthood to around age 45 for males and 35 until 40 for females. They also show in their figure that there is substantial variation in demand across individuals at all age and especially around the peak level of demand. This means that to have an ideal amount of coverage for premium risk in the future, one may have to hold more insurance than is optimal early in life, for the younger part of the life cycle where demand tends to be increasing. This turns out to be a critical factor in determining the extent to which GR can provide insurance against reclassification risks. We allow second period demand to be higher or lower than first period demand for either or both demand types. Moreover, we also allow for the possibility that demand doesn't vanish over time. Each individual's risk type also evolves over time in a similar manner. That is, individuals have the same mortality risk in the first period, but their mortality risk diverge in the second period. Moreover, in period 1, individuals hold the same belief about the evolution of their risk type for period 2. There are many potential sources of evolving demand type heterogeneity relevant to life insurance. The amount of coverage an individual desires at any point in time is affected by a number of factors, including material status, marital status, income of the insured individual, number of children, earning option for other family members, expenditure requirement for the survivor family should death of the individual occur, and the insured pure altruistic preferences among other factors. All of this can change over time. Some of these characteristics are unobservable to the insurer and others, while observable, typically have idiosyncratic and unobservable implications of individuals' preferences for insurance. We treat demand types as unobservable to the insurer or as non-contractable. Insured, in contrast, learn about their demand preferences and change their valuation of insurance accordingly. This uncertainty in future demand represents a challenge to individuals when deciding how much GR insurance is appropriate to purchase at a given point in their lifetime, which in turn compromises the ability of GR insurance contracts to protect consumers against reclassification risks. Moreover, given the non-contractible nature of demand risk, the combination of variation in both mortality risk and demand risk creates a type of adverse selection problem as described below. One important feature of interest regarding the performance of GR insurance is contract lapsation. If the renewal terms are not sufficiently attractive to people who discover they have become relatively low risk, then they will have an incentive to opt out of the first contract at or before the expiry date and not purchase a subsequent contract at the agreed open price. Moreover, if the renewal price is below the actuarially fair rate for high-risk type, which it must be to provide protection against reclassification risk, then those with low insurance demand who turn out to be high risk will wish to renew more insurance than is efficient. This means the second period contract will have a disproportionate share of demand from high-risk type, which creates a stress on the degree of front-loading required to make GR insurance financially sustainable. Our paper contributes to the literature on GR insurance by providing an explicit welfare analysis of a two-period model of decision-making based on expected utility preferences which evolve over time. Individuals may find their preference for insurance either rises or falls for the later, second period under consideration. The various possible demands for second period insurance may not align with first period insurance needs, and so the only way for an individual to hold the optimal amount of GR insurance from the second period perspective may be to over insure in the first period. Thank you.